Will Carvana be the next GameStop? Short sellers just lost $1 billion on Carvana's rise from $4 a share to $24 a share. Does it have more room to run? Hi, my name is Maaiz. I'm a hedge fund analyst turned entrepreneur, and on this channel, I'm sharing what I'm learning about the best investment strategies today. Let's go through what the short sellers are claiming in this report by Seessel and figure out who is right. Short seller claim number 1. Recent results are bullshit, and Carvana is not a sustainable business. So is the company actually a sustainable business? Carvana's key metric, the most important number to understand the health of the business, is gross profit per unit, or the amount of money Carvana makes for a car before taking into account overhead costs. Carvana announced this quarter that number is $6,000 per car. That's crazy. That's one of the best numbers in the entire industry, and that's better than anything they've reported before. Most importantly, it's a really good sign that the business model of Carvana is very sustainable. So why do I say that? When you compare this $6,000 GPU to the $2,300 the guys at CarMax reported, it becomes obvious that Carvana is doing something better than its biggest competitor. But is the $6,000 GPU sustainable enough? So if we normalize for those higher loan sales this quarter, conservatively, Carvana's GPU would still be double that of CarMax. I'd say that's still pretty sustainable. GPU is only one metric though. It doesn't tell the whole story. And if you were to go buy the stock based on just that, you'd lose your shirt. Short seller claim number 2. Liquidity is thin and investors risk getting diluted. So the real reason Carvana stock is back up to $20 or higher is because the risk of bankruptcy in the market's eyes has gone down dramatically. Up until this report of $6,000 in profit per car, the market just assumed Carvana was going to be unprofitable and headed straight for bankruptcy. So many companies have followed the path of growing at all costs with unsustainable business models at their core. As a result, it was easy to think Carvana was just another dying company. But we've already proven that the business model itself is working really well. Just given how quickly Carvana has been able to turn around their operations to focus on profitability instead of growth, investors can no longer deny the power of the Carvana business model. Carvana can be profitable, but it still isn't. So the next question is, will they become profitable? Interest on that current $7 billion in debt that Carvana has is about $150 million per quarter. And in order to pay down this debt, Carvana needs to make actual profits. They need to make cash flow. Even at the $6,000 profit per unit, Carvana is expecting to have an adjusted earnings before interest, taxes, and depreciation of about $50 million. That's not enough for Carvana to pay down its debt. It needs more income to pay off its debt. And at this point, they have a couple of options. One, they could keep increasing profit per unit. They've been working on this a while, and the $6,000 gross profit per unit is both best in class and the best Carvana has ever seen. In my opinion, it will be likely pretty hard to do much better than this number in order to increase profits. 2, they could reduce costs. Carvana has cut costs markedly over the last 9 months by reducing headcount. They likely still have room based on their current sales volume and the current SG&A costs, because in the past, they were able to do much more volume with less overhead. But they might still have another way, and that is increasing sales in order to increase profitability. Carvana stopped selling less profitable cars to become more profitable. For instance, last quarter, sales were down 25% year over year to 80,000 cars in the quarter. That's a massive reduction in sales. My guess will be Carvana will start dialing up growth again as management becomes comfortable with what the most profitable sectors of their market are and how to maximize them. The company needs an additional 1,700 car sales to add $10 million in gross profits at current margins. The last option that they might have is to restructure their debt to lower interest rates. Given how quickly Carvana has grown in the past, you can start to see the likely path for Carvana is to increase sales while sustaining current profitability. The problem is, how quickly will Carvana be able to get to profitability, and will they have to raise equity capital to do it? Given Carvana's current trajectory and their largely unused $2 billion credit facility with Ally Financial, it looks like Carvana has 2 years or more to figure out the profitability problem. 2+ years of runway seems like plenty of time to get growing again, in my opinion. Next question is, will the management be willing to wait it out and keep from raising equity? Or will they just raise equity anyway out of an abundance of caution, as many before them have done? I think this is a super important question because the right answer should be obvious, but at the end of the day, it's Carvana's management's decision, not ours as shareholders. Well, luckily for shareholders, the CEO and founder of the company owns more than 25% of the common stock. In other words, he is highly incentivized to the tune of billions of dollars to keep from raising more equity. As a result, I expect he will continue to do everything he can do to reach profitability before he has to actually raise equity cap. Therefore, he's very unlikely to dilute equity shareholders. Short claim number 3. Carvana is neither disruptive nor differentiated, and competition has caught up with Carvana. So when I read this, I almost laughed. The only competitor left in the space is CarMax, as every other competitor never reached the scale required to actually compete. If you look into the other competitors mentioned in this report, like Vroom or Shift, you would find that they sell maybe 1,000 or 2,000 cars a quarter, and they are actively looking for buyers to put them out of their misery. Lastly, the market is fragmented enough, and Carvana has gained enough traction as the default online used car retailer that it's likely they will grow alongside CarMax in this industry. At the end of the day, they are not competing against each other, but mostly against small used car sales retailers that don't have the same amount of inventory or trust or financing options as they still hold the majority of the market. In my opinion, the most likely outcome is that CarMax and Carvana will continue to grow in the online used car sales market as more buyers move into the market and out of buying from their local car salesmen. Carvana continues to have a head start in terms of buying online and their brand value for buyers. They're also likely to keep their lead as the cost of building a brand and distribution network like Carvana has become almost impossible in the current financing environment. As a result, the online used car market will only be left with these 2 big players because they've reached the scale needed to stay sustainable. Scale that no other competitor has the ability to create in this market. If you like this video, don't forget to smash that like button and check out my other videos on the topic up here. Let me know what stocks or companies you want me to look into next, and I'll see you next time.